Good afternoon. This is Ken Long at Tortoise Capital with the review of the weekend trading report for July 22nd, 2017. The market is in bullish, quiet conditions. It's favorable for long side trading and swing trading. On an annual basis, using um, NDX 260, we are overbought at 99 out of 100. And looking at the 10-day NDX for short term, we are overbought at 92 out of 100. Looking at the market mosaic, price relative to the 200-day moving average is green bullish at plus 6.68%. The slope of the 50 has improved to white neutral at 0.29. ADX is still a relatively weak 13.6, which is favorable for swing trading. As you'll see, we've started to make the long-term move out of a sideways base, so it has not yet become overswung, if you will, or overtrending. Um, Relative volatility, ATR percentage is quiet at 0.55%. The risk index is the 30 period moving average of the VIX divided by the 10 period. 1.0 is the threshold between risk on and risk off. The current reading is at 1.068, so we're into risk on. We find the z-score of that by looking at the last 5,000 trading days, finding the average and the standard deviation, and we compute the risk Z at 0.67. So 0.67 standard deviations above the long-term average. Here you see a 90-day histogram of that indicator where we have moved out of a recent swing low, and that indicator now moving higher. It becomes favorable for swing trading as it after it bottoms out and starts to curl up. So we've had favorable swing conditions for the last 5 days, which has been rewarding us in both short-term and swing trading. You see here the current holdings of the blended monthly rebalancing, and then the current leaders based on the different portfolio segments. In ETF2, the theoretical exposure and model portfolio are both at 100%. Notice here in the blended monthly rebalancing lens, looking at ATF 13 and 32, most everything is on a buy signal in both, with the exception of energy and commodity tracking fund and consumer staples. Down here in ETF 32, clear winners, emerging markets and tech. And tech and healthcare remain strong here in ETF 32, along with, of course, emerging markets and China. Under ETF Max, looking at some basically just winners across the board. There has not been much pullback except in the occasional Nordic 30, Poland, and Finland, and Greece. In the S&P 500, same lens, but looking at the top performers in the S&P 500, the only serious pullback, Jacobs Engineering, and then the ones in yellow, you can see some minor pullbacks, but really some of the uh, winners over the last week and last month have just been quite remarkable. So I'm looking for continued moves in those, or sharp reversals against a good fortune like Tenet Healthcare is one that I'll be looking at closely because of the strength in the healthcare sector as well, and along with Vertex Pharmaceuticals. There's got to be some tradable moments inside VRTX. The market health check for the S&P. This is a daily chart of SPY looking back 10, 20, 30 days on the vertical blue lines. There's the 60. The horizontal red lines are support levels that used to be resistance levels. And you can see we made a nice base here at the bottom of the dragon at 241 and have really done nothing but go straight ahead. Now, this is where that risk index really gives some help. The failure to fail further from this pinch and a declining volatility gave the early indications of a favorable potential for swing trading. And you can see here the slope of the 30, moving 30 regression line bottomed out here and started to resume. So that's always a favorable sign. After a double top of steepness in the RL30s, and then a sell off just to the break even point. That indicates 30 days of sideways price activity gets you to a moving regression line slope that's down around zero, and you read that off the left hand chart. Each time that it's gone to zero or slightly below, but then started hook back up and cross, has been a favorable time for getting long on swings, as you can see. The percent price oscillator also does a pretty nice job of finding this as a key turning point as it emerges out of the pinch, and that's the basis of our Z3 pinch idea. I mean, it's the same basic idea. ETF2 regional report, emerging markets dominating. All of the major indexes are in buy signals. That gets us to 100% invested, 0% cash. EFA at 69, still better than the S&P at 66. So the globals are favored. Inside the U.S., strength in small caps and large caps than the S&P, and then small cap or mid caps are lagging a little bit. Two strongest sectors. Emerging markets and then the European 350, the two weakest sectors, U.S. large cap and mid caps. See, basic materials and industrials are still lagging. The business cycle is still suffering, I think. Strength so far in utilities and healthcare is on the rebound after a long layoff. Looking at the market health check now, the U.S. is basically a split between slightly above and slightly below average. Asia looking generally good in Taiwan, Korea, India, and with only weakness being in Australia, Thailand, Vietnam, Mexico, and emerging markets dominating, Canada and Brazil lagging. Europe looks generally strong, no signs of weakness at all. ETF top 30. This resembles the same leaders that we saw in the BMR lens. So home builders, Korea, China, Mexico, a lot of emerging markets. Inside here, here's EEM itself, emerging markets at 76. Spain, biotech, um, and then finally the ETF liquidity, just to give some insights into average daily dollar volume traded of the last 30 days. Technology has reversed position on the small caps and now taken over the lead with EEM and financials right behind. Everything that's in white or green are ones that are above average in terms of volatilities, and if they're on this chart, they also have lots of liquidity that makes them excellent day trading candidates. Shifting to the daily report now. No signals and channeling an overreaction. You can see how the volatility has, after hitting that upper limit at Z plus 1, has rolled back down now and just nudged into quiet. Just a handful of signals from our swing patterns and a half a dozen in the auto framer that test out very well. Got some in the Dow summary, some auto framer reward to risks better than 2, with Home Depot and IBM looking really attractive, combined especially with their single digit RSI 2, and half a dozen frog quality numbers better than 3. ETF tactical summary, only the VIX right now showing any signs of auto framer value, and only the VIX and financials triggering on the ETF patterns. A few more frog quality numbers hitting. This is the summary of our new report, the daily pinch and stretch report for both the Dow 30 and the ETF 30 symbols. And so this is the first time I've talked through it with you. I'll go a little bit deeper than normal. So we've been having good success with our intraday Z3 pinch trades, where we've been getting some short-term sharp moves, and we're looking for a way to translate that same basic premise into the daily charts. And so what we have are measures of how tightly price has pinched in the last 30 days. So how narrow are the Bollinger Bands, the Z3 Bollinger Bands, and then and how widely stretched are they. So when they're tightly compressed pinched, if you will, to an abnormal condition, then that alerts us to the potential of like a coiled spring getting ready to break out when it does. Same principle as the intraday trade. The ones that have the most uh, stretch in their boxes, the unpinched, are ones that have already performed uh, a powerful swing move in one direction, and that gives us some insights about a continuation trade, one that either adds an additional leg of the same magnitude in the same direction, or has created the opportunity for a reversion to the main trade. So we're very interested in things that are cases where the river is very wide. You see Nike and General Electric are the only two in this out of these 60 symbols that have a z-score greater than 1. So that says they are very wide, and these are the widest pinch boxes with the three of the US indexes for reference. And then the most compressed pinch boxes, these are the ones where the compression of the Z3 Bollinger Band lines are abnormally tight when looked back 500 days. So if it's highlighted here in red, that means these things are more than one standard deviation below average in terms of how tight that pinch is. So Caterpillar and US small caps are extraordinarily compressed on the swing charts, on the daily charts. So the river is very narrow for them, whereas in these cases the opposite is true. The rivers are very wide among those populations. The fact that there are some that are already dipping into the red should tell you just how compressed the last 30 days have been. There has not been much movement at all in these large caps, and so the ones that have broken out then become very interesting precisely for that reason, that they are bucking the trend of the broader market, which has been trending towards narrower ranges over the last 30 days. And so the fact that it could still be exceptionally large Z3 spread is an important anomaly. Now these two columns, the most positive Z stretch, these are measurements of the closing price away from the Bollinger Band mean in terms of Z score. This tells you how far away price closed from the middle of the river, and that sets up, again, things that are in the green or in the red are ones that are more than one standard deviation away from the Bollinger Band mean, and that sets up, again, the conditions for an extreme move to come from extreme conditions, either an additional leg of the same magnitude that we just saw, or a reversion to the mean with a nice trade based on how far it's already moved. So in this case, Nike, which by the way is also an expanded box, is 6.88% away from its Bollinger Band mean, and that's a z-score. That move, the size of that move, is almost 1.79 standard deviations of movement away from its 30. So that tells you this was a very sharp move of exceptional magnitude, and that's what makes it interesting on a short-term trading basis, either both intraday and as a swing, because whatever made it move that suddenly, that sharply, could still be true, and we might see some more momentum in the same direction, or we might we wouldn't be surprised, let's say, to see a reversion to the mean with a move of about 6 or 7%. So this is an example of Nike on a daily chart, shows just how sharp that move away from the Bollinger Band mean is. That's a 6% move, and that makes it exceptional. And then you can also see how wide the Z3 lines are. Those are extraordinarily wide. So this move is sudden, sharp, and very interesting for that reason. You know, it's the difference between an explosive move in this short period of time and a grinding move like this move. Now, what makes that then interesting is we can now zoom in and start looking at trade frames that allow either support from 57 and then an extension up to the Z3, or should we get some failure below the baby dragon at the bottom of the river, so reentry of the river, would think make us think that's coming back to 55.50. And then on a daily basis, that may not look like a large move, but if we shifted down just to hourly, we could start framing some trades where a return to price around 58 looks attractive. So if this is a false move, then the move back to the Bollinger Band mean and then down to 57 becomes interesting. So that's what that looks like. Now let's take a look at a couple pinches so you can see what I mean. We'll look at Caterpillar and the small caps. Now Caterpillar is showing us a very tight pinch here in the last 5 or 6 days. You can see how wide those Z3 lines have gotten, and moments where it has pinched and then expanded have led to very interesting swings, and those become very tradable as swing trades, but also as intraday trades once they start moving. The last burst being from 94 now up to 108, so that's a 14-point move in a short period of time. And now we just saw a little bit of cracking right here. So as we zoom in, now one of the things that we could see is when you get a pinch and then an excursion to Z3 and then a reversal. Here's a move from Z3 collapse from 110 all the way back down to the Bollinger Band mean at 106. It even came down to 105 before closing. So now everything is right back here at the Bollinger Band mean and the RL270. The RL10 and the 30 are in here. The RL90 is also pretty tightly compressed here. So this is going to be a candidate for a super pinch. And so now failure really below 106 and a quarter or 106 now sets up a target over here at the RL10 belly or the baby dragon belly, or a test of the swing low. We're down to Z3, so now a move down to 102 is not out of the order at all, although 104 is probably really the first place I'm looking at. But that sets up a really nice intraday trade. And even if you can trade on 30-minute charts, you get some pretty nice swing moves inside, even using a very slow 30-minute candle. And so one of the ways we can start exploiting these daily pinches is by drilling down to fast swing trading or slow day trading through the use of 10 and 30-minute candles. So we'll take a look at IWM the same way. So we're looking at a relatively tight pinch for IWM compared to the last 5 years. This pinch is exceptional, and so that sets up some nice possibilities for directional breakouts. Now what I like is when it moves up into the channel and starts to reject. We have a 1, 2, 3 entry on the short side at about 142 with a target of the far side of the floodplain about 139. So that's 3 points. And in the index for the futures guys, that's 300 ticks. So we got some real potential for reversion to the mean and then the far side of the floodplain, all indicated by the very tight compression of the Z3 lines. And then if those fail on the swing low down here around 136, sets up an attractive place. So if support at 140 fails, the next target is support at 136. And now and then finally the third support at 134 gives you very reasonable targets in the swing time frame based on a rejection of fair value at the RL270. Now, is there reasons to not be surprised if price gets to the RL270 and then fails? Well, it has the last 3 times, and now it just did again. So now the downside move is attractive, and if you just look at this rising lows, you still get a nice an argument for a move down here to around 138. So this is how we're using these this new chart, this new report on stretches away from the Bollinger Band mean. These are the ones that are stretched above the Bollinger Band mean. These are the ones that are stretched below. These are the most expanded Z3 boxes, so they've already had their nice moves. and then these are the ones where the Z3 boxes have pinched very, very tightly, and sets us up for a bi-directional trade with no directional bias. Now, the super pinch is what we're calling those symbols where all four regression lines, the 10, the 30, the 90, and the 270, are all within the Z3 pinch line. So this 4 means that all four are within the Z3 box that's pinched. And so if you find symbols that are tightly compressed on the daily pinch box, that's this report over the most compressed pinch box. If it is the pinch box itself is very tightly compressed, and all four regression lines are within the Z3 lines, then what you have is a symbol that on a swing trade has not only become very quiet, but all of the different time frames estimates of fair value are very tightly clustered, and that sets up a super pinch or a really significant uh, potential breakout moment. So these are ones that on a for butterflies and options, or just channel breakouts from nice tight channels. These are ones that are high on our list to work, and so there's lots of tradability inside these. The thing that fills me with concern for the market is when I see the Dow 30 and the Russell both in that posture. Potential for an intermediate swing high or low has just been is really in on the books right now. So that's a brief explanation of the daily pinch. For subscribers, I just finished putting together about an hour-long discussion of this and making the video available to you in the chat room, so you can go much deeper into the concept with a lot more examples and then specific case studies of how we're trading these ideas with some success inside the chat room over the last month. This is something that came out of clarity that came out of the Kansas City live trading research weekend, and so those thumb drives are getting duplicated this weekend. Should be shipped on Monday or Tuesday. And again, the briefing that I just talked about is on that thumb drive for those of you who are not members but who might be interested. I would encourage you to take a look at those while they're still on sale. In the auto framer, moving on, now we've got a handful of ones that test out well on the swing basis, and you can see in the regression line fractals we've got some significant pulls away from the RL270 in all of the major populations. The daily squeezes, these are ones that are postured again for one-day pops based on the size of their range from the previous closing, from the previous trading day. So there's some ones, these are one-day pop opportunities. Market mosaic shows that the market has risen out of this sideways chop and given the first move away. So we have the slope of the RL30 crossed its 10-period moving average right at the long-term average and resumed this little leg where it has paused. Now the last 1-2 times it has paused, it has come back down to C-1 and held. So that's what quiet channeling behavior looks like. If the same thing were to happen, this to come to Z-1, you would see price coming down around 239 in the indexes. So failure to get there, I would interpret as a positive sign. We're right in the middle of the long-term average of slope. Nothing exceptional here. Volatility has gotten down here, it just tucked into quiet. And the 90 has started to roll back up the slope of the regression line, and the 30 has rolled and risen. The 10 is pausing. That's really the proxy for price, topping at a Z1 excursion. And then after those Z1 excursions, this is where normally you see that little failure. And so a reversion to the mean trade is the least surprising thing of all, which means that if we looked at where price is inside the river, a return back to about 240 would not be unusual. That would be perfectly expected. And that's everything I want to cover on the weekend and the daily report. I'm flashing through these other ones just so you have some reference material. So thanks for your kind attention, and we'll see you in the chat room.